Picture a quiet trading floor in lower Manhattan, late in the evening, sometime in the autumn of 2008. The screens glow soft blue in the darkness. Most desks are empty now, but a few traders remain staring at numbers that no longer make sense. Mortgage bonds with AAA ratings sitting there like treasury bills. Assets that were supposed to be as safe as government debt. All of them are falling and falling fast. Outside the windows, the city lights shimmer as they always do, but inside this room, something fundamental has broken. How did mortgages become the center of a global crisis? Why did so many brilliant investors and risk managers fail to see it coming? And what can we learn today as we think about our own portfolios and our own assumptions about safety? Before we venture deeper into this story, take a moment to like this video and subscribe, but only if you're drawn to the kind of financial history that reveals patterns beneath the surface. And if you're still listening, leave a comment telling me where you're tuning in from tonight and what brought you to this moment. Tonight, we're going to walk through that story together, slowly and calmly, with no hype and no panic. Just the facts and the psychology and the lessons that matter for anyone who wants to understand how markets really work. If you're listening to this in bed after a long day of work or watching the markets, that's exactly where you should be. This is not a story about getting rich quick. It's not about timing the next trade or finding the next hot sector. This is about understanding risk and seeing how smart people can convince themselves that danger doesn't exist. About learning to recognize when markets stop making sense, even when everyone around you insists everything is fine. So get comfortable and let the day go. And let's travel back to a time when the entire financial world believed that housing prices could only go up. To understand what happened in 2008, we need to go back a bit further. Back to the late 1990s and early 2000s. The United States had just survived the dot-com crash. Technology stocks had collapsed, wiping out trillions in paper wealth. Investors were nervous and the economy was shaky. So the Federal Reserve, led by Alan Greenspan, did what central banks typically do in tough times. They cut interest rates low and then lower still. By 2003, the federal funds rate sat at just 1%. Borrowing money had never been cheaper in modern American history. Now, when money is cheap, people borrow. And in America, there's one thing people love to borrow for more than anything else: homes. The culture around home ownership in the United States has always been special. It's not just a place to live, it's the American dream and its stability. It's wealth building and something you pass down to your children. Politicians on both sides love to talk about expanding home ownership. Democrats and Republicans agreed on this rare point. More Americans owning homes meant a stronger middle class and safer neighborhoods and better communities. Banks loved it too because mortgages had been a reliable, steady business for decades. You loan someone money to buy a house, they pay you back over 30 years with interest. If they can't pay you, take the house. Simple and safe and boring. But something was changing beneath the surface. Traditional mortgage lending used to work like this. You walk into your local bank and sit down with a loan officer who knows the neighborhood. You show your tax returns and your pay stubs and your credit history. The bank checks everything carefully because they're going to hold your loan for 30 years. If you default, they lose money, so they only lend to people they trust. This was called the originate and hold model. The bank that makes the loan keeps the risk. But in the late 1990s and early 2000s, a new model took over. It was called originate to distribute. Here's how it worked. A bank or mortgage company would make a loan to a home buyer just like before. But then instead of keeping that loan on their books, they would sell it. They would package hundreds or thousands of mortgages together and sell them to investment banks on Wall Street. Those investment banks would then turn those mortgages into securities and financial products that could be traded like stocks or bonds. These were called mortgage-backed securities, or MBS for short. The idea wasn't new at all. Government-sponsored entities like Fannie Mae and Freddie Mac had been doing this since the 1970s, creating a secondary market for mortgages. It helped bring more money into housing and made mortgages cheaper and more available. But now private banks were doing it on a massive scale, and they were doing it with mortgages that Fannie and Freddie wouldn't touch. Riskier loans and borrowers with weaker credit and less documentation. Why would investment banks want to buy risky mortgages? Because they had figured out something clever, or at least they thought they had. They realized that if you take thousands of mortgages from different parts of the country and from different types of borrowers and pool them all together, the risk seems to spread out. Diversification, they called it. Some people will default, sure, but not everyone at once. Not if they're spread across Florida and California and Texas and Ohio. So these pools of mortgages could be sliced up into different pieces called tranches. The safest tranche got paid first. If any mortgages in the pool kept paying, these investors got their money. Rating agencies looked at this structure and said, yes, this top tranche is very safe. AAA-rated, they said. As safe as bonds issued by the United States government itself. The lower tranches were riskier, of course. They got paid last. If lots of people defaulted, these tranches would lose money. But they paid higher interest rates to compensate for that risk. It seemed like financial engineering at its best. You take risky assets and restructure them so that part of the pool becomes safe. Everybody wins in this arrangement. Homebuyers get loans and mortgage brokers get fees. Investment banks get fees and investors get yield. And for a while it worked beautifully. Housing prices were rising month after month and year after year. People looked at their homes and watched them grow more valuable. A house you bought for $200,000 was now worth $250,000, then $300,000 and climbing. This created a powerful psychological effect. If your home is worth more, you feel wealthier, you spend more, and you borrow more. Maybe you take out a home equity line of credit and renovate the kitchen or buy a new car or pay for your kids' college. And if you're thinking about buying a home, you feel pressure and urgency. If you wait, prices might go up even more. You might get priced out forever. Real estate agents would tell you, don't worry about stretching your budget. In a year or two, your home will be worth more and you can refinance. You can't lose, they said. This belief that housing prices always go up became almost religious in America during the mid-2000s. Look at the data, people would say. National home prices in the United States had never fallen on an annual basis since the Great Depression. Maybe individual cities had bad years. Maybe certain neighborhoods declined. But the whole country, all at once, never in modern times. This time really did seem different. And when people believe something can't fail, they stop worrying about risk. They stop asking careful questions. Mortgage brokers started offering new kinds of loans. Creative loans, they called them. Loans designed not for someone who wanted to buy a home and live in it for 30 years, but for someone who wanted to get into the market now and worry about payments later. There were interest-only loans where you didn't pay down any principal for the first few years. Just interest and nothing more. Your monthly payment was low, but you weren't building any equity. You were just renting from the bank, essentially with your name on the deed. There were adjustable rate mortgages, or ARMs, where your interest rate started low but could jump up after 2 or 3 years. The initial monthly payment might be $800, but in 3 years it could suddenly become $1,400. Brokers would say, don't worry, you'll refinance before the rate adjusts. Your home will be worth more by then. You'll have options they promised. There were even option ARMs, where you could choose each month how much to pay. You could pay so little that your loan balance actually grew instead of shrinking. Negative amortization, they called it. You were borrowing more money every month just to stay in your house. And then there were the truly wild loans, NINJA loans, they were called. No income, no job, no assets. You didn't have to prove you could pay the mortgage, you just had to say you could. State your income and the bank would believe you. Why would a bank make a loan like that? Because they weren't keeping it, remember. They were selling these loans to Wall Street within weeks. The risk was someone else's problem. Mortgage brokers got paid on commission. The more loans they made, the more money they earned. They had no incentive to be careful. In fact, they had an incentive to be reckless. Some brokers would coach borrowers on what to write on their applications. Inflate your income a little, they would say. Say you're self-employed. Say you made $100,000 last year. Nobody's going to check, they assured them. And often nobody did check. The loan would get made and the paperwork would get packaged up. And it would flow to Wall Street, where it would disappear into a pool with thousands of other mortgages. Now you might be thinking, surely the investment banks noticed this. Surely they looked at these loans and realized some of them were garbage. Some people did notice. There were analysts and junior staff and risk managers who raised concerns. They'd see a loan file where the borrower claimed to make $200,000 a year as a strawberry picker, or a loan for $500,000 to someone with a credit score of 580. But when they raised these concerns, they were often brushed aside because the machine was making too much money to stop. Let's talk about how Wall Street made money from this. Investment banks like Bear Stearns and Lehman Brothers and Merrill Lynch and others would buy billions of dollars worth of mortgages from lenders around the country. They'd pool them together into mortgage-backed securities, those MBS we talked about earlier. But they didn't stop there. They took it further and created something called collateralized debt obligations. CDOs, they were called. A CDO was like an MBS, but more complex. You would take tranches from different mortgage-backed securities and pool them together and slice them up again into new tranches. You could even take the riskiest tranches from multiple MBS, the pieces that were rated BB or B, and pool those together. Then you'd slice up that pool and somehow, magically, the top slice would get rated AAA again. How is that possible, you might ask? The rating agencies said that even though each piece was risky on its own, when you combined them and structured them right, diversification made the top layer safe. But this was diversification on paper only, because all these mortgages, no matter how you slice them, were tied to the same underlying belief that home prices would keep rising forever. If that belief turned out to be wrong, everything would fail at once. But hardly anyone thought that was possible. The rating agencies like Moody's and Standard & Poor's gave these CDOS high ratings, AAA and AA, investment grade and safe. Why would they do that? There are a few reasons. First, they relied on historical data, and historical data said home prices don't fall nationally. So their models assumed that in a worst-case scenario, maybe prices would flatten, maybe they'd dip in a few cities, but not everywhere at once. Second, the rating agencies were paid by the investment banks who were creating these products. This was a conflict of interest. If Moody's gave harsh ratings, the bank might take their business to Standard & Poor's instead. Third, the math was genuinely complex. These CDOS had hundreds of pages of documentation, waterfall structures for how cash flowed to different tranches, trigger events and subordination levels. Even smart people struggled to fully understand them. And fourth, everyone wanted to believe. The rating agencies and the banks and the investors and the regulators. Because if these products were safe, everyone made money. The whole system worked. And for a few years it did work. Investors around the world bought these mortgage-backed securities and CDOS, pension funds in California, insurance companies in Germany, banks in Japan, and hedge funds in London. They looked at the AAA rating and the yield. These products paid more interest than treasury bonds, and they were rated just as safe. Why wouldn't you buy them? People thought. Some of the smartest investors in the world bought them. Big institutions with entire teams of analysts. The demand was so strong that Wall Street couldn't create these products fast enough. They needed more mortgages and more supply, so the mortgage lenders made more loans. They lowered standards further and stopped verifying income. They started lending to people with terrible credit. Subprime borrowers, they were called. The word subprime sounds technical, but it just means people who probably can't pay you back. By 2005 and 2006, a huge portion of new mortgages in the United States were subprime or near prime. Some estimates put it at around 40% of all new loans, and a large share of those loans were the exotic types. Interest only, an adjustable rate, an option, ARMS. Loans designed to fail once the low teaser rate expired. But again, everyone assumed borrowers would just refinance when that happened. As long as home prices kept rising, refinancing would always be possible. The housing market in places like Las Vegas and Miami and Phoenix and parts of California went completely crazy. Prices doubled in just a few years. People were buying homes not to live in them, but to flip them. Buy a condo before it's built and sell it 6 months later for a $50,000 profit. Ordinary people like teachers and nurses and office workers were becoming part-time real estate speculators. They'd watch shows on cable TV about flipping houses and think, I can do that. Some people owned 5 or 6 or 7 properties, all bought with no money down and all financed with adjustable rate mortgages. They were counting on prices to keep rising so they could sell before the payments adjusted. It was a chain of assumptions. Homebuyers assumed they could refinance. Lenders assumed they could sell the loans. Wall Street assumed the models were right. Investors assumed the ratings were accurate. Everyone assumed home prices would keep going up, but beneath all of this, something was shifting. By late 2005, housing prices in some cities started to level off. Not crash yet, just stop rising so fast. In 2006, inventory started to build. More homes for sale and fewer buyers. Mortgage brokers noticed that people were having a harder time qualifying for loans, even with loose standards. People were tapped out. They'd borrowed as much as they could. And then in early 2007, something more serious began. The adjustable rate mortgages that had been made in 2004 and 2005 were starting to reset. The low teaser rates were expiring. Monthly payments were jumping. A borrower who had been paying $900 a month suddenly owed $1,500, and they didn't have it. They tried to refinance like everyone said they could, but now their home wasn't worth more. In some cases, it was worth less than they owed. They were underwater, as they say. Banks wouldn't refinance an underwater mortgage. Why would they take that risk? So these borrowers had a choice. Keep paying a mortgage they couldn't afford on a house that was worth less than the loan, or walk away. More and more people started walking away. Delinquencies rose and defaults rose, and foreclosures rose. In 2007, a few hedge funds that had bet heavily on subprime mortgages started to collapse. Two funds run by Bear Stearns failed in the summer. They'd used enormous leverage, borrowing $30 or $40 for every dollar of their own capital. And when the value of their mortgage holdings fell even a little bit, they were wiped out completely. Investors started to get nervous. Maybe these mortgage securities weren't as safe as everyone thought. The investment banks that had created all these CDOS and mortgage-backed securities had kept some of them on their own balance sheets. Not because they wanted to, but because they couldn't sell them fast enough, or because they needed to hold pieces as part of the structuring process. Now those holdings were losing value. And because the banks had used leverage, just like the hedge funds, small losses became big losses very quickly. Bear Stearns and Lehman Brothers and Merrill Lynch, all of them had balance sheets loaded with mortgage-related assets, tens of billions of dollars worth. As housing prices fell further in 2008, the value of those assets fell too. But here's where it got truly dangerous. Nobody knew exactly how much these assets were worth. The models said one thing, but the models had been wrong before, and there was no liquid market for these products anymore. Nobody wanted to buy them. So how do you price something that nobody will buy? Banks started to doubt each other. If you're a bank and you want to lend money overnight to another bank, you need to trust that they're solvent, that they can pay you back tomorrow. But in the summer and fall of 2008, that trust evaporated. The credit markets and the system that allows banks and businesses to borrow short-term money started to freeze. Interest rates on short-term loans between banks, usually very low, spiked dramatically. The TED spread, which is a measure of stress in the banking system, went to levels not seen since the Great Depression. And then the dominoes started to fall. In March of 2008, Bear Stearns was on the edge of collapse. The Federal Reserve arranged an emergency sale to J.P. Morgan over a single weekend. In July, IndyMac Bank, a large mortgage lender, failed. It was one of the biggest bank failures in U.S. history. In September, Lehman Brothers, a firm that had survived the Civil War and 2 world wars and the Great Depression, filed for bankruptcy. The government decided not to bail them out. The very next day, AIG, the largest insurance company in America, nearly collapsed. AIG had sold billions of dollars worth of credit default swaps, which were essentially insurance policies on mortgage-backed securities. When those securities failed, AIG owed more money than it had. The government stepped in with an $85 billion loan to keep AIG alive. Merrill Lynch was sold to Bank of America in an emergency deal. Washington Mutual, the largest savings and loan in the country, failed. Wachovia nearly failed and was sold to Wells Fargo. In the span of a few weeks, the entire structure of American banking changed. The government launched a $700 billion program called the Troubled Asset Relief Program, or TARP, to buy bad assets from banks or inject capital directly into them. The Federal Reserve cut interest rates to 0. They started buying mortgage-backed securities directly to try to stabilize the market. But the damage was spreading. Because these mortgage securities had been sold all over the world, the crisis was no longer just American. European banks had bought billions worth of them. Banks in the UK and Germany and France and Iceland, some of those banks failed too. Iceland's entire banking system collapsed. The global economy went into recession, the worst recession since the 1930s. In the United States, unemployment would eventually peak at 10%. Millions of people lost their homes. Millions more lost their jobs and their savings and their retirement accounts. The stock market fell by more than 50% from its peak. Trillions of dollars in wealth vanished. And it all traced back to those mortgages, those boring and safe and ordinary home loans that everyone thought couldn't possibly be dangerous. So what went wrong, and how did so many smart people miss this? Let's think about the lessons here and the things that matter for anyone trying to invest wisely over the long term. First, there's the danger of leverage. Borrowing money to invest amplifies everything. Your gains, yes, but also your losses. And when things go bad, leverage can wipe you out completely, even if the underlying asset only falls a little bit. The hedge funds that failed were using 30-to-1 leverage. The investment banks were using similar levels when mortgage securities fell by just 5 or 10%. That was enough to destroy firms that had existed for decades. As an investor, you need to understand how much leverage you're using, if any. Margin debt and options and leveraged ETF. All of these amplify risk. And in a crisis, leverage kills. Second, there's the illusion of diversification. Wall Street convinced itself that bundling thousands of mortgages together made them safe. Geographic diversification and borrower diversification, they said. But it was all fake diversification. because everything was tied to one assumption, that home prices would keep rising or at least wouldn't fall. When that assumption broke, everything broke at once. True diversification means holding assets that don't all depend on the same underlying condition. Stocks and bonds from different countries, different sectors, and different economic drivers. You can't just diversify within a single bubble and think you're protected. Third, there's the danger of trusting complexity. The CDOS and the tranches and the waterfall structures and the models. It was all so complicated that even experts struggled to understand it. And when something is too complex to understand, that's not a feature, it's a warning sign. Warren Buffett has a rule. If you can't explain an investment in simple terms, don't buy it. Complexity hides risk, and it doesn't eliminate it. Fourth, there's the problem of incentives. Everyone in the chain had an incentive to keep the machine running. Mortgage brokers got paid to make loans, not to make good loans. Investment banks got paid to create securities, not to ensure they were safe. Rating agencies got paid by the banks, whose products they were rating. As an investor, always ask who's making money from this. Who benefits if I buy? Are their interests aligned with mine or opposed? Fifth, there's the herd mentality. When everyone believes the same thing, and when everyone is doing the same thing, it feels safe. It feels like you must be right. But markets don't work that way. When everyone believes housing prices can't fall, that's when they're most likely to fall. Because that belief causes behavior like reckless lending and borrowing that makes a crash inevitable. Being a good investor often means being willing to stand apart from the crowd, not to be contrarian for its own sake, but to think independently and to question assumptions that everyone else takes for granted. Sixth, there's the lesson about what you own. Many investors who bought mortgage-backed securities didn't really understand what they were buying. They saw a AAA rating and a nice yield, and that was enough. But a rating is just an opinion. The rating agencies got it catastrophically wrong. If you're going to invest in something, you need to understand the underlying asset. What produces the cash flow? What are the risks? And what could go wrong? If you can't answer those questions, you don't really own an investment. You own a hope. And hope is not a strategy. Seventh, there's the importance of liquidity. When the crisis hit, many of these mortgage securities couldn't be sold at any price. The market disappeared. Investors who needed cash couldn't get it. They were forced to sell other things and good assets at fire sale prices to raise money. This created a downward spiral. Liquidity matters in your portfolio. You need assets you can actually sell in a crisis. Not everything needs to be liquid, but you need enough that you won't be forced to sell at the worst possible time. And finally, there's the emotional lesson, the psychological lesson that matters most. Markets move in cycles, booms and busts and manias and panics. During a boom, it's easy to believe that this time is different, that the old rules don't apply, that risk has been conquered. But risk never goes away. It just changes form. And the more people believe risk has disappeared, the more risk there actually is. The housing bubble wasn't caused by a single bad decision. It was caused by thousands of small decisions made by millions of people, all based on the same flawed assumption. And the crash, when it came, felt sudden. But it wasn't really sudden. The warning signs were there for years. Rising delinquencies and falling home sales and tightening credit. Some people saw it coming, but most didn't want to see it. because seeing it would have meant accepting that the party was over. In the years since 2008, a lot has changed. Banks are required to hold more capital. Mortgage lending standards have tightened. Regulators pay more attention to systemic risk. But the fundamental lessons haven't changed. Leverage is dangerous. Complexity hides risk. Crowds are often wrong. And assets that seem safe can turn out to be anything but. As you think about your own investments and your own portfolio, these lessons matter. Don't use more leverage than you can afford to lose. Don't buy things you don't understand. Don't assume that because everyone else is doing something, it must be smart. Think independently and ask hard questions. Be willing to be patient and to miss out on the hot trade. To sit on the sidelines when things don't make sense. The investors who survived 2008 weren't the ones who were the smartest or the fastest. They were the ones who were careful, who didn't overextend themselves, who kept some cash on the side, who remembered that markets go down as well as up. The years after the crisis were hard, but they also created opportunities. If you had cash in 2009, when stocks were cheap and everyone was terrified, you could buy great companies at incredible prices. That's the paradox of markets. The safest time to invest often feels the scariest. And the scariest time to invest, when everyone is euphoric and nothing can go wrong, is often the most dangerous. It's late now, and the story has been told. The screens on that trading floor in Manhattan have long since gone dark. The crisis of 2008 is history now. But its lessons are timeless. Markets will always cycle. Booms will turn to busts. New innovations will create new risks. And people will always be tempted to believe that this time is different. Your job as an investor is not to predict the next crisis. It's to be prepared for it. To build a portfolio that can survive bad times as well as good. To stay rational when others are losing their heads. It's not exciting and it's not glamorous, but it works. And now it's time to rest. Let go of the charts and let go of the worries about tomorrow's market open. The markets will still be there in the morning, and so will you. Sleep well